Hey, what's going on guys? Welcome to this video. In this video, I'm going to be going over the concept of liquidity. What is liquidity? Why liquidity is important? What are some important liquidity pools? And how can we use liquidity? How can it benefit us as a trader? Now, as a smart money trader, as a ICT trader, liquidity is a very important concept, and it's one of the most crucial concepts that you need to understand before you start your journey as a trader. What is liquidity, right? So liquidity is pretty much areas where market participants stops are resting, and it can be sell side liquidity where sell stops are resting, and then buy side liquidity is where buy stops are resting. So let me go ahead and talk about exactly what this is. So pretty much when we're in a market, right, financial market, market makers, which are the banks, which is the institutions, are pretty much just trying to take out any retail traders that are in a trade to fill their orders, right? So for example, if I'm in a sell order, if I'm in a sell trade, right, if I'm shorting something, market maker will likely go ahead and take out my stop loss so that they can they can continue to sell and make money from there on, right? So let me show you an example here on the chart. So if let's just say for example, if I had shorted this move right here, if I was in a trade, if I was in a short trade right here, where would my stop loss be? My stop loss would be right above this high, right? As a retail trader, or even any kind of trader, my stop loss would be above this high. Now what the market maker will do is they will move the market above this high to take out any kind of liquidities here, right? Any buy stop liquidity, and then push it down more, right? So this is how market pretty much moves, and it's very important to understand what this is and how to utilize this concept as a trader, right? So if I'm in a short trade right here, what would be sitting on top of this swing high? There will be buy stop, right? So my buy stop will be sitting right here, and market maker will move the market, take out my buy stop, and then move the price down lower. All right, so now let's talk about why liquidity is important. So with proper context, it can give us an indication on potential price direction, and you can also trade liquidity runs as well as trade the liquidity as an objective, right? So if we do have a proper context and everything lines up, we can get a clear direction of where price might be heading. Where is the market going, right? And we can use liquidity as we can trade liquidity in a form of a liquidity run where price takes out a certain liquidity, and then we can trade against that, or we can trade to that liquidity as an objective, right? So let me show you in the chart again here. So let's say for example that this is the liquidity right here, right? This is the liquidity that's right here. So what we can do is, if price is, let's say if price is like right here in this area, we can trade towards this liquidity, right? We can go long towards this liquidity as an objective, or what we can do is we can wait for this liquidity to get swept, this liquidity to get run, and then we can trade short, right? So after this liquidity gets run, we can go short, and then there will be another liquidity target below here, right? So hopefully that makes sense. Okay, and let's talk about what liquidity pools are important. So okay, first of all, not every single swing highs and lows are going to be presenting important liquidity pools. Instead, we should look at specific data points and specific levels to find more important and major liquidities. And these are some of the important liquidity points right here: previous month highs and lows, previous weekly highs and lows, previous day highs and lows, previous session highs and lows. And then I also look into highs and lows that's inside of a fair value gap. Okay, so let me show you in the chart here. Okay, so I have lined up already the things that I want to show you. So this is the NASDAQ, right? And I'm looking at the chart today here as of April, what is it? Sorry, May 3rd, 2024. So this is the May market just opened for May 3rd. I'm sorry, May 2nd. Market closed for May 2nd, and it's about to open for May 3rd. So as you can see, if I go to the weekly time frame, we have the previous week high here, previous week low here. So we can use these as a important liquidity area, right? So we can wait for price to either run this liquidity and then go short, or we can trade up to this liquidity point as an objective, right? So if I go to the daily time frame, we can see that previous day high, previous day low. So for example, today what we did was we took out the previous day low and then market moved up higher. So we could have waited until this previous day low was ran or swept, taken, right? And then we could have went long off here until the next target, next objective, right? So we could have done that. And we could have also traded towards that. So for example, we could have went short here and then traded until previous day low, right? And then this is the session liquidity here, session high and low, London session, London low, London high, London low. And I actually took this one trade this morning here. Let me show you here on the 15-minute time frame. So we took out London high here, right? And then we formed some kind of sell model here. So I actually shorted here, and I think I closed it up until this fair value gap. I shorted like up here and then closed right here. So another concept that you can also use with liquidity is internal liquidity range to external liquidity range. So I'm not going to be talking more about that today. I can make a separate video for that. So pretty much how price moves is that price moved from external liquidity to internal liquidity. So external liquidity is any kind of highs or lows, and then internal is fair value gap. So for example, here we went from external liquidity, so London high, to internal fair value gap. Okay, so these are important liquidity points that you can look into. All right, now let's talk about how is liquidity helpful. Liquidity is helpful to us as a trader in sense of finding draw on liquidity, where price might be heading to, right? So it can help us understand where is price heading to, and it can help us build a bias, right? It can kind of help us predict what the price might be doing. I mean, you can't 100% predict the market, but it'll give you a sense of where price may be going to, and then it also helps us understand and identify reversal points, right? So let me go back to the chart again and show you exactly what I'm talking about. So this morning when I was trading the pre-market, I saw that price took out this London high. So in my mind, I'm like, yeah, this high got taken out, this liquidity got taken out. Now where's price going to go, right? So I mean, if I didn't know about liquidity or anything like that, I wouldn't know what the price was going to do. But since I knew that this liquidity pool, this high was taken out, I had some kind of sense that price was going to go down, maybe until the next liquidity, right? But it's not going to go to the next liquidity right away. So I waited for a setup. I shorted it around right here, and it went into this fair value gap. So it just gave me some kind of sense. It gave me something to look at, and it kind of helped me understand where the price is going. And even here, when we took out that previous day low, I knew that price was going to go higher because we already reached our objective of take this liquidity. And now the only thing that price might be doing is that it's going to go higher unless we have more liquidity below this that are important, right? So it'll just help us understand where our drawn liquidity is, where price might be heading, and it will help us understand where our reversal points are, right? So in context, in summary, liquidity are pretty much just where the areas where stops are sitting or resting, and areas where market maker will use to take out those stops so that they can fill their position and move the market to where their objective is, right? So if in this sense here, if the market maker, if the institution wants the price to go higher, right? If they want to go higher, they will dump it down, take out any kind of stops, sell stops sitting below this, and then they will move the market higher, right? And similar to here, if they wanted to take the market down, they will take out buy stops and then move the market lower. So that's pretty much it. Simplified, liquidity simplified. Hopefully this made sense. And if you guys have any questions about this, please feel free to comment below. And if you think that I didn't explain something well enough, let me know. I will try my best to explain it better. And if you guys have any other questions, let me know. And thank you so much for watching. See ya.